For the next hour, you'll be leaving the Show Me state and entering the Show Me the Money state. So stop what you're doing, grab a pen, and get ready to learn. Jake Floyd of Floyd Financial Group will be your guide for straight talk and honest answers about living the life you deserve in retirement. So prepare to be empowered. Now, here are your Show Me the Money hosts, Jake Floyd and Jeff Shade.
Thank you so much. Welcome to Show Me the Money with Randy and Jake Floyd, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about the retirement squeeze, why it still feels tight. Also, target date funds, set it and forget it or not. Also, the retirement mistakes that people realize when it's too late, and finally, should you tap into your home equity? Or is that a trap? My name's Jeff Shade. As always, I'm just here to ask the questions, but the words of wisdom and solid advice, they come from Randy and Jake Floyd at Floyd Financial Group. And Randy has the day off this weekend, so Jake, it's just you and me. How you doing this morning?
I'm doing great, Jeff. Thanks for asking.
Certainly welcome, my friend. I hope everybody else is having a great weekend. Believe it or not, it is the last few days of May here. June's just around the corner. June 1st is going to be on Monday. Okay, so let's get started here, Jake. Social Security COLA's going up. The market's been holding up, but retirees are telling me the same thing over and over. You know, it still feels a little tight. Why is this happening, Jake?
I think it feels tight because it is tight. And I'm just not sure that these inflation metrics that they measure with are anything even close to what's actually happening, what the average person is actually spending. I just don't think it's the same thing. I don't know where they're getting these numbers, but to say that things are 2.8% more than they were last year, to me feels like lunacy. I mean, it has to be more than that, right? And certainly if we factor in since 2020, the cumulative increase in prices, something like 40%. Again, I dare you to name me something that's only up 40% since 2020. I mean, there's so many things that are double and triple. Maybe the only thing that's up that much is maybe rent, but I think rent's even up more than that. And so it feels tight because it is tight. And until people stop spending, that's going to be the case. Nobody's going to lower a price out of their own volition. As long as people are paying it and are able to pay it, people are going to keep charging it. So I think that people really feel it at the grocery store. This year, we've felt it a lot on insurance premiums, whether it's even like health and life insurance is up for like new policies, but even property and casualty, the insurance on my business went up like 25% or something last year. There was a lot of catch up going on. Car insurance is way up. Homeowners insurance is way up. And so it's all these little things that you don't get any pleasure from doing, right? So like, at least if you go buy a steak, you get to eat the steak, right?
I don't get pleasure from paying my insurance bill. I know that for sure. Yeah.
So I think that's why it feels so bad, is you're like, somebody's just robbing the bottom of your pocket and you're getting nothing for it. It's the way it feels anyway.
Well, isn't inflation based on a market basket of goods? Is that how they measure it? I don't know what market basket that they're using, but it's not the same market basket that I have when I go to the supermarket. And you're right. Some of the things that a couple of years ago, you know, as I keep harping on this little wrap sandwich that I like to get in the Hy-Vee, it was $3 just about, 18 months ago. It's $6 now, and it is rising. So again, I don't know where they're getting these inflationary rates, Jake. Is it a CPI market basket of goods?
So I think there's a number of levers that they're pulling to make it seem less bad than it is. Yes, there's a basket of goods that they look at. They never really talk too much about that basket. You can find it out on the web. But if we look at what's in that basket, I don't know how this thing being up 200%, this one being up 250%, this one being up 75% equates to being up 40%. Like the last time I checked, the average is the average, not the average of three numbers can't be half the lowest number.
Right.
I mean, like beef prices, beef prices have got to be close to 100% up over the last 5 or 6 years. I can feel the cattle farmers listening here nodding their head. It's up a lot. And while that's good for selling cattle, you still have to replace those. You have to feed them. All the things that you have to do that isn't free. There's a lot of people that are getting out of the cattle business because the overhead cost is so high that you better make a whole lot when you go to auction, because if you don't, you're going to be in big trouble. Looking at the situation, and now we have oil prices higher, which is not helping anything. One of the metrics that they do is like, well, when you back out the price of oil, it's not too bad. I'm like, how do you even do that? How do you take the cost of something and back out the price of oil? Because it's multiple layers deep. Now, if you're going to back out the price of oil to get a good from China to here, yeah, well, we just deduct the fuel cost increase and voila. No, it doesn't work that way, because whatever happened over there also costs fuel. And whatever got the pieces to that machinery there costs fuel. There's no getting rid of the fuel cost. You can't adjust for that. And so I think that's part of it, is there's a lot of hidden math going on that makes it sound better than it is, but it's incongruous with how your wallet feels.
Talking with Jake Floyd, Floyd Financial Group. We're talking about the retirement squeeze here today in our program. 417-889-7233 is our number if you'd like to get in and sit down and talk with Jake or Randy when he's in the office about your journey towards a confident retirement. No cost, no obligation for that conversation. It's 417-889-7233. Jake, let's talk about Social Security. We got a 2.8% increase here in the calendar year 2026, but boy, inflation is not 2.8%. Do you think that really made a dent in anything, just getting 2.8%? And what are we forecasting? What are we looking for the COLA increase for 2027?
I would say half of people that are on Social Security basically broke even or lost money to the increase in Medicare Part B. So one hand giveth, the other taketh away. No, I don't think anybody felt like they got a raise other than just seeing the number go up a little bit, but I don't think it feels like a raise. Now, it's not necessarily supposed to feel like a raise, right? It's supposed to make it feel like it did last year, but I don't think that that's the case. I don't think anybody really feels that way about it. So when we're looking forward to this year, it's looking like the forecasts are saying we might be as high as 3.9 or 4% this year, which if we don't get this oil thing figured out, it might be higher than that. I mean, I know Trump's over there making moves and doing things, but I'm ready for him to get this thing put to bed, because we cannot allow the midterms to be compromised by this game that we're playing in Iran. And I do not envy his job. And don't get me wrong, I'm criticizing a little bit, but again, overall, I think he's doing a pretty good job. But I think that we got to get this thing put away. We cannot allow the midterms to be a casualty. There's just too much at stake.
So if I'm hearing you correctly, Jake, what it is that oil is the big thing that's driving this. And unless we get that fixed, we just got more of the same here. Do you think that that is the number one, or at least maybe the only thing that is going to solve this inflationary problem right now?
I think it's responsible for 80% or so of the inflation we're seeing. I think there's other things too, but just like we were talking about the cattle business, oil, the price of oil, and therefore the price of gas is affecting the cattle business too. It's not just the cattle business has its own thing going on, but taking cows to auction costs fuel. Tending your field costs fuel. Baling hay costs fuel. It's exacerbating an already increasing price market. And so I think that that's the easiest thing to fix. And I do think we're probably on the cusp of fixing it, but we need to get it fixed, and we need to get it fixed kind of yesterday.
Jake, this is the part that confuses people. I think the markets are doing very well. They're okay. They're more than okay. And portfolios look pretty decent on paper, but people are still feeling squeezed. Why do you think that is?
Yeah, Jeff, I think what people don't realize, they've been working their whole careers, they've been saving money, and they've been making more and more and more income, is once you get to retirement, it's about cash flow. It's not so much about income anymore. And it's not about net worth. It's not about how big your house is. It's about how many dollars do I have coming in versus how many dollars do I have going out. You can have a pile of money on paper, but if your monthly income is not such that you have some breathing room in your discretionary income, it's going to feel tight. And in this area, there's a lot of people that are frugal. There's a lot of conservative Americans in this area, and I suspect we got some listening right now. And sometimes those people have a hard time spending their money. They've worked their whole life to accumulate what they've got saved up, and they're like, hey, I'm supposed to be saving, not spending. And people have a hard time making that switch. So it could be partially because maybe you're not spending enough of your money each month to make ends meet, but a lot of it's just when that cost keeps going up, it's harder to feel good because it presses on your discretionary income. If your income is not going up and your costs are going up, then everything just feels tighter and tighter and tighter.
Jake, I want to talk to you on Social Security just a little bit once again. That is an income source that a lot of people have. Most people have that are listening to the program today. It makes up about 35-40% of someone's entire income. There is a way that you can affect how much Social Security that you get, and that is when you take it. Are you finding that more and more people are waiting until the age of 70 because they're just going to get more? Or in other words, how do you determine when the best time is to take Social Security?
I think a lot of it is that if we're waiting till 70, there are a few good reasons to do that, but most people that are doing that are just simply misinformed. They look at that bigger number and they're like, hey, if I wait, I get a bigger number. But if you really do the math and you look at what you're giving up to get that bigger number, if we look at break-even analysis on Social Security, if you take it at 62 versus 67, the math will work out to you got to be 78 or 79 to break even, meaning that 5 years worth of payments you missed for that to be eaten up with a bigger income payment. You got to be 78, 79 years old. Will you live that long? Probably. But that assumes a 0% rate of return on that 5 years worth of income payments. If you even put those payments on deposit at 5%, now you got to be at like 95 to break even. And the fact that we're asking the question, should I wait to file till 67 or 70, implies that you could wait, meaning you don't necessarily need the money, which means we should be calculating some interest rate on that. So the Social Security question boils down a little more simply than a lot of people think it does. And we'll talk about this more when you come in for your consultation. And this is the number one thing that I talk about. But in many cases, if you're actually retired and you're not going to go back to work, you probably should turn on Social Security. Now, again, I'm not giving blanket advice here, but many, many times, 90+% of the time, I think it makes sense to turn on Social Security if you are no longer working. Why if you're no longer working? Because if you're still working, you can only make a certain amount of money without having to pay it back. But if you're totally retired and you're going to stay retired, turning it on makes sense because we don't want to spend your money down. We want to use Social Security's money in so you can keep your money so you maintain control. Once you're 67, I think it's very difficult to make the argument to not turn it on no matter what because you're no longer penalized at that age. And having that money in your pocket and your control and earning interest on it, in my opinion, is better than saving up for Social Security that you may or may not get, Congress may or may not cut, and nobody's guaranteed tomorrow.
So, Jake, we've talked about all the outgo that people have here and the fact that inflation is up, oil prices are up, and we're sort of making it clear that, hey, things are more expensive than they used to be, but I'm getting ready to retire right now, Jake. I'm sitting in front of you and I go, Jake, I've cut my spending to the bone. How can we increase my income? Is that a fair question, or how should we approach this?
Yeah, so for some people, it may just be a little too soon to retire. This is one of the things that we calculate when you come in for your consultation is, if you're not retired yet, you're a couple of years out, we can look at what the income would be, look at what you're used to spending, look at what you would have to spend, discretionary spending, what are you going to do with your time, all these different things that come in. So some people may have to work a little longer, or maybe you hate your job. You're like, I got to get out of here no matter what it takes. Maybe you go get a part-time job somewhere doing something that you like, something that you don't despise the way you currently despise your career. And there are some people that don't want to stop working.
Right.
And that's the one case where I think you can make to wait on Social Security potentially is if you're going to work past 70 and your goal is you just want to work as long as you possibly can. There can be a case to be made to wait on Social Security, especially if you're married, to help protect your spouse if he or she has a lesser Social Security. There's some things to consider, but you may need to look at your investment plan and see if it's producing for you what it could be from an income standpoint. Because, if we have money just kind of sitting in CDs, we're just at the mercy of what the CD market, the rate market is going to give. And if we go back at some point to a 0.25% world on CDs, that could be painful. So looking at the overall plan, figuring out how much more blood we can squeeze out of the turnip, and so to speak, is one of the things that we spend a lot of time doing here.
Well, as Randy uses the expression, the long and short of it here is that the key is to have some clarity. I think a lot of people go into retirement, Jake, on hope and a prayer. We're all for prayer here, but hope is not a good retirement plan. You want to have some clarity to that. So if you are listening to the program right now and you're realizing that inflation isn't going away, taxes aren't going down, healthcare costs aren't getting cheaper, the question is, does your plan account for that? Or maybe you don't have a plan. Well, if that's you, call us here at Floyd Financial Group for your Floyd Financial Retirement Review and get some real answers about your income, your risk, and your future. It's not going to cost you a dime. 417-889-7233 is our telephone number. We'd love to hear from you. Again, entirely complimentary. And there is no judgment. We'll meet you where you are. 417-889-7233 to get your Floyd Financial Group Retirement Review. I think you'll be glad you did. Jake, time for a break here on Show Me the Money. When we come back, we're going to be talking about target date funds. Set it and forget it or not. When our program continues here on 104.1 FM KSGF, where Springfield comes to talk.
Ready for another helping of some more real money talk? Thought so. Now, here's another serving of Show Me the Money with your hosts, Jake Floyd and Jeff Shea.
Welcome back to Show Me the Money. I'm Jake Floyd, and in this segment, we're going to be talking about target date funds. Dun, dun, dun.
The ominous music there, Jake, and that's for pretty good reason, too. We'll explain it. Target date funds, you pick a year, you throw your money in, and you're done, right? Well, maybe not. Today, Jake, of course, we're going to break down whether these set it and forget it investments are really that simple, or if retirees could be taking on more risk than they realize. Jake, are target date funds as easy as they sound?
I would say that they are as easy as they sound because many people put their money in there and never look at it again. So I think the people using them would consider that they are easy, but I think that in reality, there's a lot going on under the hood that a lot of people don't realize. The idea behind choosing a retirement year and going with that fund and then just setting it and forgetting it is appealing to people because investing can be very complex and most people don't have a background in it. But there are some other considerations, some drawbacks to be careful of.
So, Jake, I'm sure that a lot of people have heard of target date funds. They're in a lot of 401ks, I think in most 401ks, and people don't realize it. So explain exactly what is a target fund? How does it work?
Yeah, so I think a lot of people, when they pick these funds, they understand that it should be appropriate for them based on their retirement date. But I don't think most people understand how that works and what it is that they're invested in. But I think that's true of all mutual funds and packaged investments, but I think it's especially true of target date funds. So the idea is if you're going to retire in 2045, you buy the target date 2045 retirement fund. And using stocks, bonds, maybe some alternatives depending on the company, they allocate your money over time to where it starts more aggressively and then it gets less aggressive and less aggressive until you get to your target date, in which case it's much less risk, but also in some cases much less reward. But that all happens without you having to do anything. And if we've learned anything over the last 6 years since COVID, is that convenience is king.
Jake, is the big appeal to target funds the fact that it is that easy? I mean, did they just hit the easy button?
I think that the Staples "that was easy" button is one of the best marketing things ever in history. That was a great thing. Anyway, back to the retirement date funds. I think that simplicity and convenience is the reason. Not only for the employee, but also for the people who work in HR. They direct people to these funds so they don't have to have a real conversation about what's available inside the funds. And they're like, hey, you know, the guy at Vanguard or Fidelity or Franklin Templeton or Capital Group or whoever said, hey, we just buy this fund and we're all good. So I think it's encouraged by a lot of HR directors when a new employee comes into the plan. We're like, hey, just get this target date fund and it'll fix you right up. Some of the plans default to those. If you sign up for the plan, it just automatically takes your age from 65 or what year you'll be 65 in and throws you in that target date fund. And then you have to physically change it if you want out of there. But yeah, I think younger people who don't understand what's going on, who don't understand how important it is, but also people that just don't want to have to become an investment expert tend to use these funds. And again, it has worked out for some of them, but it kind of depends on what your goals are, how much your risk tolerance is, how much international investment you want to have, which we'll touch on here in a minute. But I don't know that it's a one size fits all the way they seem to be being used right now, because something like 60% of all funds and qualified plans are in target date funds, which is a humongous amount of money. We're talking trillions and trillions and trillions of dollars in these funds. And I'm not sure they're understood well enough by the average person for that to be the case.
So, Jake, if I pick a target date fund, and let's say that I pick target date 2030, that's when I want to retire. What is inside this target fund that is going to allow me to retire in 4 years?
Yeah, so in a 2030 fund, you're likely going to have something like 50% of the money in that fund allocated to bonds and 50% to equities or other risk investments. A lot of people don't realize it might be as much as 60-40 stocks to bonds. It depends on the fund company. Each company has a little bit different take on it, but it's going to be in that ballpark somewhere. So I think most people perceive that if they're in the target date fund, they're invested in the stock market. I don't think it's immediately clear to most people that they have a significant amount of bond exposure inside these funds, especially as you get close to the retirement date. You're going to have a lot of bond exposure, and that's an interest rate sensitive investment. You also may not be getting rewarded the way you think you should be. If the market is ripping like it has been over the last little bit, you may not be getting adequately rewarded. But I think just understanding what you own is step one. I would say probably less than 10% of the people I see could actually tell you what they own when they come in with a 401k.
So let's say, Jake, that you've got a 60-40 stock bond split inside your target date fund, 60% stocks, 40% bonds. Let's talk about bonds a little bit. I understand that bonds are the biggest investment class out there. How have bonds performed in the last year or two?
Well, if you've met an American, it shouldn't be a shocker that the biggest investment form out there is debt.
Yeah.
Bonds over the last 10 or 12 years have been incredibly lackluster because we had low interest rates and now we've gone up in interest rates. So the average bond return over the last 10 years is something like 3% on a well-diversified bond portfolio, which is pretty terrible because the stock market over the same period is, I'd have to look at the exact numbers, but I would guess 200% plus over the same period versus a cumulative return of maybe 40% in the bond market. So not that those things are meant to compete, but at the same time, you've left a lot of money on the table if you're more than 5 or 10 years out from retirement and you have a lot of money allocated to bonds. So that being said, I do think looking forward, bonds could be a pretty good investment once we get the interest rates under control a little bit here. But it's not that stocks or bonds are the enemy. It's the lack of unity of what you're invested in versus what you think you're invested in, right? That's the thing. Probably the biggest one that I think bothers people around here that they don't know is, and again, this is me generalizing, but I would guess that the average target date fund has about 40% of your money overseas, international investments. Mm-hmm. That's my number one gripe with target date funds is if you ask Vanguard how much money you should have overseas, if you leave it up to them, they'll have 40% of your money in international investments. Wow. Which I think is way, way too much, which means you're going to have something like 15% of your money in China, which is crazy, like to me. Now, there's a lot of people who are like, oh, I don't have any issue with China. I don't want to be invested anywhere that can just nationalize property overnight. They'd be like, hey, I like that business. I think I'll take it. Or, hey, that CEO said something bad about President Xi. I think we'll just disappear him in the night. Retirement's hard enough without having to worry about all that. So I'm not a big international investment guy. I'm a big domestic guy. I love the United States of America. I think it's the greatest country in the history of the world. And I think it has opportunities that countries only dream about. And because of that, it also means profits that other countries only dream about. If you zoom out the chart longer than about 2 years, if you look at a 5-year, 10-year, 20-year time horizon, the United States market beats everybody else very handily. And so over time, I want to be more exposed to the United States than I do the rest of the world. Any given month, that could be different. But over time, the United States market is better. And I have a very heavy United States bias in my investing program, basically.
Jake, I'm getting the feeling here that we don't like target date funds, but I do want to continue this conversation. Talking with Jake Floyd, Floyd Financial Group, 417-889-7233 is our number. If you suspect you have target date funds in your portfolio, you want to maybe look under the hood and see if there's a better alternative. Again, call us here and request your Floyd Financial Group retirement review. No cost, no obligation, 417-889-7233. And then, Jake, there are the fees with target date funds, which I think most people do overlook.
Right. And I would say this is true of all investing, where people don't realize how much they're paying in fees because the company really doesn't disclose it in a way that they can see. There are a lot of fees inside of funds that are charged by the funds, but there's also a lot of other fees related to trading and churning the account and turnover and all kinds of different things that are in there that don't necessarily get shown in the prospectus, just shows up in lack of performance, which is why most mutual funds underperform the benchmark a lot. There's the fees on the funds that you can see. However, if you have a target date fund, you will see that you're paying somewhere between 0.2 and 0.7% on most target date funds out there. But what you don't know and what they do not say is that inside that target date fund, if let's say, for example, you have the T. Rowe Price target date fund, inside that target date fund, there's somewhere between 5 and 10 more mutual funds is how they stack it. So they have the first wrapper of fees, but then each individual investment inside also has a fee. So they're double dipping. And this is the reason why the investment companies love target date funds, because they get paid twice. Now, there are some exceptions to that. Fidelity does not charge on their wrapper. I think Vanguard does not charge on their wrapper at all. But most of the companies do, and they like this double dipping aspect of things. All the target date funds, though, use their own funds inside. So they use one fund to feed their other funds. So that can add up to quite a lot of fees that you don't know you're paying.
So, Jake, as I said, I'm getting the feeling that we do not like target date funds. 60-40 stocks and bonds. Bonds have not performed well. And I'm looking at this and I'm going, wow, this is just not what I want, but I still want to retire in 4 years in 2030. So what are some good alternatives to a target date fund?
Yeah, I think talking with an investment advisor and helping them understand your goals and when you're wanting to retire, you can go into these plans. Most plans will have an S&P 500 fund or a bond aggregate fund or something. And what you can do is strip away a lot of these fees and have a very low cost portfolio. If you know what you're looking at, you can do it yourself. Or if you have an investment advisor that can point to it and go, hey, how do we look at this? Now, I will tell you that not all investment advisors are going to want to help you with your 401k because they don't get paid on it. I will tell you, though, that I have lots of people that come in to see me when they're 5 years from retirement or whatever, and they say, hey, how am I doing? And one of the things I will do is go through and look at all their investment options inside their 401k. You'll have to bring that in because each 401k is different. But if you bring in your investment options to your consultation, I'll look at the portfolio and I'll kind of go, okay, here's what we should get rid of. Here's what we could keep. Or let's change strategy here and let's strip out as much of the fees as possible, because fees are kind of the number one common denominator in eating up your return. So if we can minimize fees and maximize performance, that's what we want to do. Now, again, there's a lot of investment advisors that won't want to do that for you. I do not charge to do that, but obviously it's in my interest to help you so that when you get to retirement, you have more money for me to work with and everybody wins, right? So I'm happy to put in that work ahead of time to benefit your situation, whether you choose to come back to me in 3 or 4 or 5 years or whatever it is or not. I want to bring value to the situation, and that's one of the ways we do it.
Jake, great conversation here. I want to talk to our listeners for just a moment. Most people in a 401k are in a target date fund because it was just default. It was the easy thing to do, but it was not the right choice. So if you feel that the target date fund is not serving you as well as it could, call us here at Floyd Financial Group for your retirement review, and maybe we can find some alternatives for you to your 401k to find out whether it's really aligned with your retirement goals. Call us here at 417-889-7233. You can make that call right now if you want. Leave your name and telephone number, and Ashley will call you back during the week and find a convenient time for you and Jake to sit down and talk about your 401k and see if we can find some good alternatives to your target date fund. No cost, no obligation, no judgment. Again, that phone number, 417-889-7233. You can also find out more about us online at floydfinancialgroup.com. Jake, time for another break. When we come back here, we'll be talking about the 5 retirement mistakes that people realize when it is too late. When our show continues here on 104.1 FM, KSGF, where Springfield comes to talk.
We're back with your financial catch of the day, and it's a big one. Here's more Show Me the Money Radio with your hosts, Jake Floyd and Jeff Shea.
Welcome back to Show Me the Money. I'm Jake Floyd, and in this segment, we're going to be talking about the 5 retirement mistakes people realize too late.
And Jake, you know, I talk to a lot of people who say, I'll figure out retirement later, when I get to it. And then later shows up and it's expensive. Well, today, let's talk about some mistakes that people only realize when it's too late and how to avoid becoming that person. So let's start with the big one, Jake. Why do people delay retirement planning so much?
I think that some of it is fear of bad news. I think it's the same reason people don't go to the doctor as often as they probably should, is the fear of getting bad news, that you're not prepared for retirement or Some of it's just laziness. They're like, hey, I'll worry about that later. I'll worry about that later. I'll worry about that later. And then pretty soon it's later, right? And you're still haven't worried about it. So I think people are procrastinators is a lot of it. But all that being said, it's also very intimate. Talking about your money and your finances is one of the most intimate things you can talk about with somebody. And you may not want to share that information with somebody. They're afraid somebody's going to say, why aren't you saving more money? Or why aren't you doing this or that? People don't like to be told that they're doing it wrong. And so when people come in to see me, it's not like that at all. I just want to understand who you are, what's important to you, and figure out how I can best help you get to where you want to go. That's it. There are some nosy questions I have to know the answers to, like what's important to you, maybe some info about your kids, things like that, so that I understand, where the money's going when you're no longer here, what you're going to be spending your time and money doing, make sure you have enough disposable income to do the things you want to do, how much your car payments are, stuff like that. But again, you don't have to answer anything you don't want to answer. And I'm not going to be pressing, but at the same time, the advice is only as good as I am informed, if that makes sense.
It makes a lot of sense there. And I think that people underestimate the power of time and compounding. And starting late means that you got to save a lot more aggressively and you're going to be taking on more risk to catch up. The earlier dollars are the most valuable dollars that you'll ever invest. So this isn't about saving, it's about when you save. Okay, Mistake number 2, Jake, is my expenses will drop. A lot of people think, hey, I won't be working, I'm going to spend less. That's not necessarily true, is it?
Jeff, I would say that the average person probably spends slightly more in retirement, but they spend it on different things. When you're working, you obviously have to worry about your wardrobe a little bit more. If you have a uniform, you got to worry about a car to get you from point A to point B every single day to the office, that kind of thing. Sometimes in retirement, you don't have those things. Sometimes you have more of those things. Sometimes in retirement, you're spending money filling your time. So there's some people that spending goes way up whenever they retire. And that's why one of the things I ask people a lot about is, what do you plan to do with your newfound time once you're retired? If you're planning to travel the world, that requires a lot of money. If you're planning to sit at home and play with the grandkids and tend the cattle or whatever it is that you like to do. Some people have hobbies that make them money. Everybody's quite different. So I try to not put my preconceived notions on them and let people tell me what they want to do, what's important to them, where they're at. But sometimes in retirement, you spend more. Sometimes you spend less, but I would say on average, you spend slightly more in retirement. However, it doesn't take nearly as much money in retirement, meaning you spend a little bit more, but that doesn't mean you need more gross income. Before you're retired, you have to fund your retirement plan. You have more in taxes. You have Social Security tax. You have FICA, Medicare, Medicaid, workers' comp, all the things that come out of there that you don't have anymore once you're in retirement or you have less of. So you're still going to pay some taxes, but chances are you're going to pay a little less in taxes in retirement, maybe a lot less in taxes, depending on what tax bracket you're in right now. So it doesn't mean you need to make more in retirement. It just means you might spend a little bit more. And so that's why it's important to gauge these things before you pull the trigger on retirement, if you can, preferably. So that way you can have a chance to get to where you want to go. If you've already retired and you come in and say, Jake, I retired last week, I can work with that too. I'm just saying, in all things equal, you'll probably have better results if you come see me a year or 2 or 5 ahead of time.
We're talking with Jake Floyd of Floyd Financial Group, and we're talking about retirement mistakes that people realize once it is too late. If that is you, call us at 417-889-7233. We'd love to sit down and talk to you about your retirement plan. Make sure that you've got enough money to enjoy your retirement. You were talking about people spending money in retirement a little bit more than they thought that they were, Jake. And, we know a lot of people in this part of the country who like to hunt and fish. And boy, a hunting rifle, a good one, can be expensive. And I asked Randy once, so we were talking about his bicycles, and I said, how many bicycles do you need? And he said, the number that you have plus one. It's always that. Same way with rifles and guns.
And plus one.
And plus one. You always need one more. Well, I like to fish as well, too. Well, how much is a bass boat? 22-foot bass boat. It's a lot of money out there. So, yeah, you got to figure in what you're going to do in retirement and design an income plan to support that. Mistake number 3 really scares me, and that is one income source. People relying on one thing, one pension, one property, and one account.
Yeah, Jeff, we call that concentration risk. So having just Social Security or having a little Social Security, a big pension, or maybe you've been a property owner, so you have a rental property, or you have one big account that everything has to come out of. So it's good to have a few legs to your stool to make sure it doesn't tip over on you in retirement. So having more than one income source is generally a good thing. Not everybody is going to have that luxury. Many people that come to see me have never had a pension or anything. They have a 401k that they saved up, and they have Social Security, and that's about it. And that's okay. But with that 401k money, we may want to devise a plan that utilizes a few different buckets of money so we have a little diversification of strategy, diversification of income, and be a little less susceptible to things jumping out to grab us.
So it seems like the people really should be thinking in terms of having a layered income. As you said, Social Security is one leg of that stool. We've got investments, possibly annuities or other income stools. That's only 3 legs in the stool. I think that would be a little wobbly. I'd like to add another one there too, at least have 4 legs on that. It's about reliability and not just returns. This one surprises people, Jake. It's mistake number 4. They get close to retirement and they say, I'm going all safe. I'm not going to take any risk whatsoever.
Yeah, and so if you have an obscene amount of money saved up for retirement, much more than you need, that could be a viable strategy. Every once in a while, somebody comes into me and they've got $4 or $5 million and they just need $50,000 a year off of it. And yeah, you can afford to not take any risk at that point. Now, I would argue, though, that you're going to have some drawbacks to that. Your buying power is going to get eaten away at. The parable of the talents, for example. We should be good stewards of what we're given, and we should maybe not be reckless with risk, but we should maybe take a little risk to make sure that what's entrusted to us grows and that kind of thing. So yes, it is possible to not take enough risk and just succeed in spending your money down. There's a few people that can afford to do that, but most people need to have some risk to grow their money to replace what they're taking in income, or at least help it not spend down so quickly. But we take that into account. Risk tolerance, risk capacity, we talked a lot about last week with Randy. Those are major factors that get built into any plan. We don't want you sitting up wringing your hands at home, worried about what the stock market's going to do. That's not people's idea of a great retirement. So everybody has a little bit different tolerance for risk. Everybody has a little bit different capacity for risk, meaning how much risk can you really afford to take? Retirement isn't the end. It's just the start of distributing that money. Mm-hmm. And we still need that money to be growing over the next 20 or 30 years. So it's possible to be too safe to where safety actually becomes a risk.
All right, Jake, that brings us down to mistake number 5. And this may be the biggest wild card of all of them. It's how long you're going to live.
Yeah, a lot of people will come to me. This is the big Social Security question. They're like, well, when should I file for Social Security to make sure I get the very most out of my money? Say, well, if you can tell me the day you're going to die, then I can tell you what the best strategy is. But since nobody can tell me that, all we can do is use the system to our advantage and use probabilities as our guide when it comes to family longevity and things like that. But nobody knows how long they have. Nobody's guaranteed tomorrow. And that really plays a big factor in how we plan for retirement, especially if you have a spouse or if you have other family members that depend on you. What happens if you don't live very long? How do we account for that? What if you have a big pension and that's the main part of your retirement income and it doesn't survive to your spouse? How do we deal with that risk? Is there things we need to look at there? So I think people look at retirement planning sometimes and they're like, well, I have a pile of money and I just take income off of it. And while that is true, there are so many potholes along the way that can jump out and grab you. And I've said before on this show, but I think it's a good analogy. Not every pothole is a problem. Sometimes you'll hit a pothole and it's just a bump.
Right.
But every once in a while, there's one of those potholes that everybody knows to avoid on the old dirt road because they know that's a car killer. You know, it'll rip your front end off if you get in that one. So knowing which potholes are a problem, which ones are a big problem, and which ones are just road noise is probably the biggest place that I can bring value to a situation.
Talking with Jake Floyd of Floyd Financial Group, and we've been talking about retirement mistakes that people don't realize until it's too late. If you're within 5, 10, and maybe even 15 years of retirement, this is not the time to guess, because I think the biggest mistake that we've talked about here, people waiting and then running out of time. So pick up the phone right now and get your Floyd Financial Group retirement review. We're going to show you where you're exposed, how to create real income, and whether your money will actually last as long as you do. Call us at 417-889-7233. It's 417-889-7233 and ask for your Floyd Financial Group Retirement Review. No cost, no obligation, and no judgment. You can also find us online at floydfinancialgroup.com. Okay, Jake, time for a break. We come back here on Show Me the Money. We're going to be talking about whether or not you should tap into your home equity, or is it a trap, when our show continues here on 104.1 FM KSGF, where Springfield comes to talk.
Ready to climb a mountain of financial know-how? Good, because it's time for more Show Me the Money with your financial Sherpa, Jake Floyd.
Welcome back to Show Me the Money. I'm Jake Floyd, and in this segment, we're going to be talking about, should you tap your home equity, or is it a trap?
And Jake, Americans are sitting on trillions and trillions of dollars in home equity right now, and a lot of people are thinking, hey, that's my money. I should use it. Is that a mistake to think that way, or is it a big asset that maybe you want to draw from? What's your opinion on that?
Well, if you're a beneficiary and you're looking to inherit a big property, I'm sure you're saying, no, don't do it, right?
Yeah.
What I would say is, if you don't have to, I agree that we probably shouldn't. That being said, if life has thrown you more than one curveball and you're a little behind the eight ball on retirement spending, tapping home equity can be the difference between you retiring and not being able to retire. And so I think it's a little dangerous to say this is never a good idea or it's always a good idea. I would say it depends, like a lot of things on this show. But there are definitely some risks, but there can be some benefits depending on how we do it.
But here's the key. It's a paper gain until you actually sell or borrow against it. And people are accessing that in a few different ways, right, Jake? What are some of those ways?
Yeah, so there's a few ways. I would say a lot of people are thinking, hey, I'll just take a second loan out on my house and I can get it out. And that can be true. But then you're stuck with a payment. Some people spend out of a HELOC, a home equity line of credit. That can be very expensive because a lot of HELOC rates are variable rates. Even the ones that are not variable rates are very high rates comparatively to a traditional mortgage in today's world. There's HELOCs out there at 9 and 10% and that kind of thing. That's quite a bit of interest. Again, getting a second loan could potentially make sense, but you're not going to get as good a rate as you are in your first loan, and you may have mortgage insurance premiums and things like that. And then there's a reverse mortgage. A reverse mortgage is a mortgage where you take the loan out, and instead of making payments on that loan, it just accrues interest against the loan, against the property. And so you never make payments. The interest rate just accrues more and more interest inside the loan. That scares a lot of people. I will tell you, in the right situation, that can make a lot of sense. Even if your house is totally paid off, you can use a reverse mortgage to generate income. Let's say your house is, you have a 30-year mortgage and you got 6 or 7 years left, but you're ready to retire now. You could use a reverse mortgage potentially to pay off the existing loan so that you don't have a house payment. You may not get a lot of money out of it, but getting rid of $1,000 a month house payment might be the difference between you retiring and not. Like we said earlier in the show, retirement's about cash flow. It's not about gross income. Sometimes the best way to do that is to eliminate a payment, not to increase income. There's a lot of different ways to tap home equity, but that's a few of them.
Jake, I think there's a lot of misunderstanding out there about reverse mortgages. I want to talk about it a little bit. I've heard people say, well, if I get a reverse mortgage, I'm not going to own my home anymore. Is that the case?
Yeah, so a reverse mortgage is similar to a traditional mortgage where the house is still yours, but you owe somebody money on it. And many times in a reverse mortgage, it's just going to be a bank, just like a normal mortgage. There's a few other stipulations, like they will not, on a normal mortgage, you can tap 80 to as much as like 97% of the home's value. On a reverse mortgage, in today's world, it's going to be more like 25 to 50%, depending on your age and some other factors. So you can't get as much money out of it. But for most people, if you have to tap home equity to survive, adding $1,000 or $2,000 a month house payment is not going to help your situation. So I am a fan of the reverse mortgage in 10 or 15% of the situations out there where your health is really either failing or you're 70 and no real retirement in sight. But if you could get rid of your house payment, that would give you enough cash flow to make ends meet. I think it can make a lot of sense there. Now, there's a lot of things to consider when we're talking about a reverse mortgage. There's relatively high cost to reverse mortgages versus traditional mortgages. Understanding how the interest is going to accrue on you instead of it being the balance is never going to go down, it's only going to go up. And just understanding the math and everything there. So there's things to think about. And I'm not in any way saying that a reverse mortgage is a great idea for everybody. I'm saying in certain situations, it can make sense to tap your home equity.
Talking with Jake Floyd, Floyd Financial Group. We're talking about tapping into your home equity. And again, our phone number, 417-889-7233. If you'd like to sit down and talk with Jake about maybe tapping into that home equity and the different ways to do that. Now, Jake, we have a colleague on the radio here, Dave Ramsey. I think a lot of people know Dave does a great job with educating people about God's and Grandma's ways of handling money and avoiding debt. And when you bring up reverse mortgage or you bring up tapping into home equity, his opinion is do not do that. Why would you want to tap into something that is probably your greatest appreciating asset? How do you look at that? Is that the right way to look at it?
You know, I think Dave does a great job at helping people get their debt paid down and that kind of thing. I don't agree with Dave on a lot of other things. He's a big buy it and hold it mutual fund guy, which I'm not a great big fan of. When it comes to tapping home equity, I would just say that Dave has never had to do that.
No. He's made a lot of money.
It's easy to sit on your mountain of hundreds of millions of dollars and say, well, don't tap into your home equity. That's a horrible idea. Well, if you don't have any other option to get retired, I would say that could potentially be different. And to be fair, I don't think that you should willy-nilly tap your home equity. I don't think that's a great idea for most people. But I do think there's some people listening to the show right now that have been thinking to themselves, how am I ever going to get retired? I'm 70, I have a little bit of money saved, and Social Security is just not enough. This can be an outlet. And just full disclosure, I don't do reverse mortgages, so I'm not in any way pumping this, trying to talk my book and hoping you're going to come in and do a reverse mortgage. I'm just saying it can be a tool for some people. And I think Dave sometimes is a little jaded in his palace. Again, I do think he's an okay guy, and I do think he has helped millions of people get out of debt and help understand debt, he's brought a lot of millionaire perspectives to average people. But I would say that it's a little short-sighted just to say never do this. I would think it's also short-sighted to say that it's your greatest appreciating asset. I would take big issue with that, especially from this point moving forward. I think it's going to be very difficult for housing to maintain the current trajectory on value that it has been on in the last 20 years or so. But the stock market has dwarfed the housing market as far as return, too. So I don't know that I agree with that part. But I do think keeping debt under control is a good thing. But if you are in a situation where you're even having to ask the question, should I tap my home equity, then maybe you're in a different boat than some people are in who would never ask that question simply because they don't need to.
Yeah, and I think Dave would say, don't tap into your home equity, get a side hustle like delivering pizzas or something like that. Well, I haven't seen a lot of 70-year-olds bringing me pizza at my door. So, as you said, Dave does a great job, but it may not be the right answer for everyone. So let's talk about timing a little bit. Why is now maybe a little more risky in tapping your home equity than it used to be?
Yeah, interest rates are quite a bit higher than they have been anytime in the last, let's say, 18 years or so. So tapping your home at 7, 8, 9, 10% gets very expensive very quickly. 8% on $50,000 worth of home equity is $4,000 a year in interest. That's a lot of interest. So I agree, like with Mr. Dave, that it's not something we should do lightly for sure. But there are some situations where it can make sense. But if you're thinking, hey, I'm going to tap my home equity and use it to travel to Europe and that kind of thing, I don't know that I love that idea so much. Because you're basically putting it on a credit card, except the credit card comes and seizes your house when you don't pay.
Yeah.
And so I do think that can be a dangerous game. But again, I do think there are some situations to do it.
So, Jake, what's the biggest mistake that you see people make over and over again?
So people sometimes will treat their home equity like an ATM. I think this is true of younger people more than people that are in retirement, but it's true of everybody to some extent. You know, prior to 2022, when interest rates started to rise, for the previous 20, 25 years, it was very common for people to spend a bunch of money on credit cards, cars, whatever it may be, and then come in and say, hey, I'm going to smash my house piggy bank and refinance my house, get more cash out, pay off my lifestyle debt, and then go again. That works as long as interest rates are low and stay low, and as long as housing keeps appreciating. If either one of those two things stop, the music stops. And I think that some of the squeeze we were talking about earlier in the show is due to the fact that people have not been able to tap the piggy bank because interest rates have been so high. If they tap the piggy bank to pay off debt, they have to pay off the existing mortgage. And if they do that, their interest rate goes from 3% to 7%, and their payment's going to double or something. So it's actually better for them to just keep the credit cards at this point, even than doing that. So it puts us in a little bit of an interesting predicament. But I think that's why the risk is a little bit higher right now, or the trap is a little bit more real for people, because they're still spending like they can tap the home equity, but they really can't.
We're talking with Jake Floyd of Floyd Financial Group about tapping your home equity. And Jake, let's bring it all home here. Bottom line, what should listeners take away from our conversation here today?
I think, can tapping your home equity make sense? Yes, but we have to be selective about how we do it. It's not something we just hit the home equity and go to Vegas or put it in the stock market and multiply it and then pay the mortgage back off. I've literally had people suggest that to me. I would definitely not endorse that behavior. But for a select group of people in the right situation where you really need to be able to tap that equity, I think it can make a lot of sense. And ultimately, it's your life, as long as you understand the ramifications of what you're doing and understand what you're getting yourself into. I think you should be free to do what you want to do. But again, we want to be careful.
So, Jake, if our listeners are sitting there thinking to themselves today, I got a couple of $100,000 in home equity. Should I use it? Well, don't guess. Before you touch that equity, you need a plan. Not just, can I get the money? How quickly can I get it? But should I take that money? Well, here at Floyd Financial Group, we're going to walk you through the pros, the risks, the cons, and possibly some smarter alternatives. If you would like to get your questions answered about tapping into your home equity, call us and request your Floyd Financial Group retirement review. It is absolutely at no cost and no obligation. And as always, there is no judgment. We'll meet you where you are. Our phone number, 417-889-7233. It's 417-889-7233. Set up that conversation with Jake or Randy when he's in the office and get your questions answered about tapping into home equity. You can also find out more about us online at FloydFinancialGroup.com. Well, Jake, we just get started, then we run out of time. I certainly want to thank you for your time this fine weekend, but also I want to thank our great listeners here in the last bastion of sanity, Springfield, Missouri, for joining us. So for Jake Floyd, I'm Jeff Shade, wishing you a great weekend. We'll talk to you again next week right here with another edition of Show Me the Money on 104.1 FM KSGF, where Springfield comes to talk.
The information provided in the preceding program is for educational purposes only and is not intended as investment advice for any individual or entity. All information contained herein is believed to be from reliable sources. However, we make no representations as to its completeness or accuracy. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Please consult your financial professional before executing any financial strategy. Financial planning is offered through Floyd Financial Group, LLC, an SEC registered investment advisor.